Hello, Rich Dad Insiders, and again, it's Robert Kiyosaki, and I thank you for being part of Rich Dad Insiders. I'd like to explain a little bit about debt, but more importantly, big debt. Because everybody says to get out of debt and get out of debt, but what the U.S. government does, and many world governments do, is they get into a lot of debt. And right now, as we're speaking, the U.S. government, when they say they're going to print $1 trillion, that means $1 trillion worth of debt, and that's big debt. So right now, I think most of you already know, if you've been following the insiders, is that what the Federal Reserve and the U.S. government is afraid of is a thing called deflation. And the way they're going to solve deflation is increase debt. That's what they're doing. So they're flooding the markets with tons and tons and trillions of dollars and all this, hoping it doesn't go to deflation. Now, obviously, you already know, if they succeed and they actually stop deflation, if they succeed, then what we're going to have next is inflation, because they've flooded the market with so much money, and there'll be people, you and I will be flush with cash, and we'll feel better, think we're intelligent and geniuses, and we go out and buy something. And so when the moment we get all of this money, they know the average person will go out and start spending it, which will cause inflation. So one of the things people ask, what is the Federal Reserve Bank going to do, or Ben Bernanke or the U.S. Treasury going to do? What they have to do to prevent this, because they're afraid of this, that they're more afraid of deflation than inflation. Inflation they can control, deflation is tougher to control. So by flooding the market with lots of money, they hope to cause inflation. So the question is then, how do they plan to sop up or soak up all of this cash sitting out there? So right now, the U.S. government is just pouring money into the economy. But eventually, they hope that it'll cause inflation. So what they're going to do then, and the way they're getting debt out there, is to keep interest rates basically, at 0% if they can, and all this, hoping you and I will borrow more money. So as it starts to inflate, what they're going to do, which they have done in history, is they'll raise interest rates. So back in the late 70s and 1980s, they raised interest rates up to like 20%. So when people, and that's when I started to invest, was during this time period. So back in the 70s and 80s when I was investing, I was happy to get a home loan for 14% interest. I was just thrilled. So the way they sop up, like I said, they pour money into this economy right now, and the way they sop it up, and this is what Paul Volcker, who was Ben Bernanke's Federal Reserve counterpart back then, by raising the interest rates up this high, then you and I, who are savers, or the savers out there, they then say, oh my God, the U.S. Treasury, which is debt, bonds and Treasury bills, they said they're going to pay me 20% money. So what that does, it sucks the money back out of the economy, and then people who have a lot of cash become winners. So at this point then, if they do this, savers then become winners because suddenly they're getting 20% interest on their accounts. The problem with that is high interest rates then kills the economy again. So basically, that's in a very simple nutshell, that's the game the Federal Reserve, I believe, is playing right now. They're going to dump a lot of money in the market, and then they're going to hope before this goes out of hand, they're going to try and kill it by raising interest rates. And that's very simply the mechanisms that the Federal Reserve and the world central banks use to play games for the economy. So you've got to be very, very aware of it, watching over the next few years these two factors. So for now, savers are losers, but pretty soon debtors could be losers also if they raise interest rates too high. I don't know if that's going to happen. As I said in an earlier segment to insiders, if all of this money doesn't stop deflation, we go into hyperinflation or depression. And this is absolutely horrible. Either one, either hyperinflation or a depression. That's what they're afraid of. So if the whole thing works ideally, they'll pump some money here, the money will be sopped up here. So the people with the cash will then put it back in the banks, and let's say you have $1 million, 20% interest means you get $200,000 a year. And so you're living happy with that much. So basically, that's the kind of games they play. They pour it into the market with debt, and they pull it out of the market with debt again, right? So that's the answer is on debt. That's how they play the game. Thank you very much, insiders.